Hey guys, good morning. This is Julie. Have a customer who's asking, to give some more explanations of the Jats PT levels and the probabilities of the weekly, quarterly, daily, etc., how they can use it in their trading. So that's a great question. The first thing you want to do is understand the standard deviation bell curve. And you basically have a bell in a normal distribution that comprises 68% inside the 1. And then if you break the 1, you go to the 2 and or the 3, up or down. And if you break the 3, you're going out into the tails. So you can go out into the tails trying to reach a higher time frame, 1, 2, or 3, or you can return back to the middle or the other side. So basically, the standard deviation bell curve will be long and narrow when you are inside the 1, and when you go towards the 3s, it flattens out, right? Because it starts leaving the range. The bell curve will flatten down as it goes outside that range. There are 68, 95 rules that I adopt in our trading. And so I can't tell you how we measure our indicator, but it's pretty much based on this empirical rule of the 68 to 95. That's what we're basing our model on. I don't really, go to the 99.7 because, I just pretty much stop at the 95. Um, but with all of that said, let's take a look at the PT level. We've got a monthly contract coming up in the Euro USD, and the silver lines are some put and calls that I've gotten off of the quick strike. I'm going to show you that in just a second. But the monthly one is where price came back to rest on Friday. When you break the 1, the dealer's looking to go to the 2 and the 3 like they did the previous uh, month. In November, it broke the 1 and went all the way a big bar to the 2, and then it went to the 3 at the end of the month. And now we came back to the bottom of the monthly 1 and bounced, broke the upper monthly 1, but have come back to test it. Um, and we're going to flip around just a minute. I'm going to show you the quick strike again. Come back over here. This is the expected range that you can get for implied volatility. Implied volatility is forward looking based on option contracts. Historical volatility is based on past historical actual volatility levels. And you can see that the quick strike implied volatility expected range, you can get it for any instrument that they have. They've got agriculture, energy, equity indexes. They do have foreign exchange, and for your major pairs, here's a Euro USD, and you can see for the time frame for the expiration, there's not really a quarterly contract. There's a monthly and a weekly and a Monday, Tuesday, Wednesday, Thursday. So they have 0 DTE, a weekly, and a monthly. Um, the equity indexes have a specific quarterly contract that the Euro USD does not have. Um, I might even remove that from the Substack now that I've noticed this. I don't trade a lot of forex. In fact, I didn't trade any. So, but here, but it works the same. Um, Here we have the 1075 and 109 put. Those are the silver lines that you saw on my chart. And for open interest, you can see that 109 and 1095 are the two put walls, and 1075. And so I put those lines right here on the chart. And the 109 is almost to the mean of that monthly contract. So this, if we get a reversion to the mean next week, that is in confluence with that 109 strike. Um, and you can see that the market, when it broke the mean, it came back to test it. And then we've broken out. But we're sitting on this upper one. So if it goes back inside, I'd be looking for, the what the market might anticipate the forward-looking implied volatility levels as noted here. Your outside strike is 1.135 and that 2-3 line is at 1.125. Right there, and 1-135. Right there. So 135, look at that. That's where the high was, and it's come back in. So it hit your monthly expected call, and it has come, that was the 3 for your implied vol, and it has come back inside. Um, let's look to see what some open interest change is. So you can see that that 11075 is really the high mark right now. So keep an eye on this implied vol leading you to what the market participants are looking for versus the historical volatility where the dealer hides their puts and calls behind. Because the dealer's not going to show you their levels like is shown on these implied vol levels. There is another way to look at these pricing sheets on Quick Strike's website. You can register for Quick Strike and get your pricing sheets and open interest, run your spread builders. I use an old sheet. Nick has gracefully allowed me to keep it, but this is the new sheet, and so just keep an eye on where you think that the market might be heading. You've already seen the high volume, and you can see their implied volatility levels 1, 2, 3. So I would use this. I also use mine. I asked Nick to put this on here for us um, to be able to look at the settlement versus the current um, levels. If you're doing intraday trading, you might want to use your current levels. I like historical volatility, so I'm looking at past levels, more of a concrete support resistance. But if you're doing this current intraday trading, you might want to uncheck that and look at your current levels so that you get your volatility change. Another thing about Nick that he has that it's available is a quick sheet, and you can EUUF4 come in and pull up a contract and design your own columns that you would like to see, how you would like to see your puts and your calls and your change and your deltas and your delta changes laid out, so that Quick Strike is one of the most advanced analytic platforms available anywhere. Highly recommend it if you're trading futures and options on futures or forex. And then you can see where these volume puts and call volume um, come into play. I'm trying to grab this to pull it back up here. Hang on a second. Here we go. So we can see our high puts are at 109, exactly where I put the line. So I would use this in conjunction with your Jats PT historical levels to give you an idea of how the historical volatility lines up with the implied and help you with your probabilities. But if you look again, the weekly and daily intraday ranges can be very helpful. Like if you're inside the ones, you're just going to be rotational in and out. If you break the one, that's when you can start moving to your higher time frames. How I do this is I measure again from the mean to the three. I'm going to say this so many times, you're going to really understand it. Mean to the three, right? And I take 1/2 of that distance and carry it out of the three to get my first tail target. Target 1. Carry it from the mean to the three. See the distribution expanded here. And do my Fibonacci 50%. And then carry it out. Or this one went one time, so you don't have to carry it out. Sorry. So this one went an actual full one-to-one, one time outside. So you see how the algos work with this historical volatility? So it went one time. It went 1/2 time, and then it went one time. And that was just last week. So it's better to have the Jats PT on your chart. You can be drawing the distributions yourself. You can put whatever levels you want. You don't have to use the measured moves like I do. If you would rather use your Fibonacci numbers, you can put whatever you want in there. 38.2, what are the levels? I don't use Fibonacci, but it's 61.8, you know, blah 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 blah. You can put anything you want. If you wanted to look at a two time the distribution, or point 42, whatever you wanted to put in there, you could put in there for your extensions, so you're not limited. But so you can draw calculations from the open or the close of the session. And for the market analyzer, I capture from the open of the session. The market analyzer is for the session opens where you're in the middle, going from the mean to the three. The calculations on the close are also starting from the mean to the three, but they're projected closes, and the market analyzer does not capture those. So you're getting them open. And that is the explanation. I hope you understand historic volatility is actual grabbing of what has already happened, and implied volatility is our expected range going forward using option prices. Okay? And I use both to get my probability assumptions. I will go inside my quick strike. I will look at my puts and calls for the implied vol, and I will mark them on my chart. Um, you can click on a level. Well, let's see here. Get my old sheet up. Over here, you can click to pull up the puts and calls. And I'm wondering, can you do that on the new sheet? No. But there is a way for you to look at that with your other tool. I'll have to figure out how he looks at those. But your expected range tool, I can give you this right away. You don't even have to register. You can just use this link I will give you, and you will be able to pull up any product that they offer for metals, interest rates, foreign exchange, equity indexes, energy, cryptocurrency, agriculture. Um, and the quick strike, though, does have a little bit more. We can go into fixed income and volatility indexes. So you'd have to subscribe for this. There's your difference. But you sure do get plenty on the free version. I think it's worth a subscription, and that's something that you probably will elevate into once you've been looking at his expected range implied volatility tool. For any length of time, you're going to be wanting more analytics. It's an excellent platform. CMEgroup.com and Quickstrike, QUIKSTRIKE. So between the implied volatility expected ranges based on options versus the historical volatility versus on what's actually happened in the past, I can't give you my exact model how I do it. That's proprietary, but we we can get you a good analysis of where we believe that the one, two, threes are going to be. Um, FYI, last week on the SPX, let me pull that up for you. Just FYI on the SPX, I'm sorry. We showed this last week a couple of times. We got right to the end of the quarterly three, and everyone was not able to get their 4,800, but it was because the JH um, QEX or whatever it is, the letters, acronyms for the JP Morgan hedge fund um, quarterly caller, their long put ended at the quarterly three, and it was right there, and that's where it ended. Okay, so what I'm trying to say is, I think I've proven my calcs abundantly over many different times of showing you guys where, the market comes to our historical volatility levels and will stop on a dime, and it doesn't really matter what the implied volatility calls or puts or deltas or anything have, because if you're in at the end of a historical volatility level, the dealer uses those levels. Clearly, I have proven that over and over and over again. That's our belief. So you definitely want to look at both, but that's why you want to add Jats distributions to your analysis, because we will provide you what we believe to be the historical volatility levels. All right. Thank you so much. Y'all have a great weekend.